surprise here, but this podcast is brought to you by AssetDash. AssetDash is the best way to track all of your investments in one place. We support over 100 different platforms and blockchains, and everything from crypto to stocks to DeFi, NFTs, banks, and more. Simplify your investing life with AssetDash today. What is up, everybody? Today we have Alex from the Science of Hitting, who will be, one of our first equity analysts that we'll have on the podcast. I've spoken with Alex before. He's extremely knowledgeable. He has an amazing Substack that we'll include in the link to this with information that comes out on a weekly basis. A great Twitter feed as well. So we are excited to jump into some of the recent earnings. We've had a ton over the past 2 weeks. We're going to pick a few and jump into it with Alex and talk about his excitements, some disappointments, so on and so forth. So Alex, thanks for jumping on.
Yeah, thanks for having me. It's been an eventful couple of weeks, as we were saying right before we started recording.
Yeah, it definitely has. With that in mind, what I wanted to start off with is, out of all the earnings that you've looked at over the past few weeks, let's talk about some of the surprises to the upside and to the downside. What stuck out to you in both those categories, and what particular companies I think fall into those buckets to kind of warm things up for the audience.
Yeah, well, the downside ones are probably a little clearer to spot. So let me start there. Many of these companies haven't reported their earnings yet, but we've gotten updates from the prior quarter. Retailers have definitely been a spot where U.S. retailers specifically, where there's just significant cost inflation, and the companies that I tend to follow in that space, Dollar Generals, Walmarts, Targets, Costco's, et cetera, you're seeing significant headwinds in terms of consumers needing to allocate a larger percentage of their budget to core needs, food and beverage, CPG, et cetera. So general trend there, as I kind of see it, is Walmart's explicitly said this: double-digit cost inflation in those kind of categories. So units are, probably basically flat, but significant cost inflation. So you're getting reasonable revenue growth out of that bucket from that component. The offset is, and in combination with, kind of COVID hangover, discretionary categories have really taken a hit, and we've heard other companies kind of reiterate those sentiments. I'm thinking of Microsoft and Apple, for example, talking about kind of PC shipments, which has also been impacted by lockdowns in China. So supply chain issues there. So that's been one notable one that's, it's pretty important if you're talking about someone like Walmart that does $500 billion in revenue. So it's not a one-off. It's pretty representative of kind of broader economic concerns.
And on that point, in any of those calls with the retailers, did any of them cite to seeing solutions in the near future on the supply chain issues, or are they all basically saying they see it getting worse or staying the same?
I haven't heard much in terms of it being fixed in the short term. Target's business mix is a bit different than Walmart. Walmart's much closer to a grocery store, and it's over 50% of their mix is grocery. Target's a much lower level, so their business is a bit different, but they've seen a very significant impact in terms of kind of where they expect operating margins and operating income to be at for this year. So again, discretionary categories are, it sounds basically like they got oversupplied. They're kind of a first tier customer for their suppliers, and they were able to get product, but now it sounds like demand on the back end is kind of dried up pretty quickly. So they're navigating through that issue.
How are you navigating investing in these retailers?
It's kind of funny. So taking a step back, I invested in Curate, which is basically a TV-based retailer / distribution platform. And when I made the investment, part of the thesis was around the step up they had seen early in the days of COVID. And when they reported Q2 21, I believe, I started to see signs that there were maybe questions about the sustainability of that demand as we move further through the pandemic. And you can also just pull up a chart of, U.S. retail sales. And I started to get really skittish and that, it really speaks to a lot of the specifics of that situation. But it's when I first started really keying in on this. And that's roughly around the same time, I believe, that I first invested in Dollar General. And what makes Dollar General unique to me is it's very much, I just consider it basically a rural grocery store. That's the majority of their business, and the need that they're serving is much less discretionary. They do sell apparel and other things, but it's really more of a grocery store in my mind. So I've been approaching this kind of from the jump in terms of who is least exposed to that 2020, 2021 earnings power being inflated, and to what extent, who knows? But I was kind of worried about that from the jump. And so far it's worked out reasonably well. And again, who knows, it could just be a couple of quarters or a 1-year hit to a Walmart or a Target, but we'll have to see how that kind of fleshes itself out. But Walmart in particular, as I wrote in one of my write-ups, you can just track spend that doesn't fall into the grocery category. And the growth that they saw over the past 12, 24 months was quite a bit higher than what they had seen in those categories over the past 5 years or so. So it was, it's pretty representative of kind of what I'm talking about. So that's how I've navigated it so far. I have a position in Dollar General, but I don't own any of the other retailers.
Got it. And then on the upside, are there any names in particular that surprised you in a good way and you're more confident in now after what you saw from the last earnings?
Yeah, Airbnb reported last night, and they had another strong quarter, in my opinion. They're benefiting from a number of trends that are playing out right now: strength of travel, long-term stays. Another thing they're really benefiting from is they saw a very significant impact very early during the pandemic to their business, and it caused them to become leaner and really to reassess key things like level of marketing spend. What do we need to kind of drive this business? And I think some of the insights that they derived coming out of the pandemic are really showing up in the financial results today. So that's one example. Another one is kind of the big tech guys that people have been talking about for a long time, thinking of Microsoft, Amazon, Google. Given what's actually going on, the results that they reported this past quarter, and also the commentary as we're looking forward. I'm thinking specifically of Microsoft, another year where they're guiding to double-digit top line and bottom line growth, inclusive of a very significant headwind from currency. So, these companies are clearly winning in the markets that they're competing in. As Satya Nadella, Microsoft CEO, kind of put it, they're in businesses where they can actually demonstrate value regardless of the macroeconomic cycle, and a downturn is an opportunity to even further present that to their clients. So they're just riding a structural tailwind that doesn't seem to have any signs of slowing down, at least currently.
And on the Airbnb side, did they allude to anything remote work related?
Yeah, so they've been disclosing for a while now the mix of the stays that are 7 days or longer, and then 28 days or longer. And 28 days or longer has been right around 20% of their total nights booked, and 7 days or longer, inclusive of that bucket, has been right around half of their business. So it's not up. It hasn't increased very significantly as of late, and it actually took a bit of a step back in Q2, but this is definitely still an important part of their business. And for them, for that company in particular, they're if you go read their press release, it's interesting. They're leaning into remote work and sticking with that view in a way that, in my mind, is starting to look pretty unique relative to how everybody else is. A lot of companies are kind of normalizing again. Airbnb is very much committed to this idea of this is a competitive advantage to be able to give employees very significant flexibility and to not be constrained by, the geography of our offices or whatever it may be. So it's really interesting to watch. I'll be curious to see how that plays out over a couple of years.
Amazing. And then another one that you had alluded to on the Amazon side of things, I haven't followed it. So you said a lot of the other retailers are struggling outside of AWS. How has Amazon been holding up on the e-commerce side of things?
I haven't looked particularly closely, but from what I've seen, it looks like it's still pretty strong. I was actually DMing with someone on Twitter right before we hopped on this call, and based on the numbers they showed me, it looked like it was still fairly impressive relative to, what a clean comp would be. Someone like a Walmart, US e-commerce, which has, again, significant benefits during the pandemic, but a bit of a hangover now, and it's become harder to grow that business on now a larger base. It seems like Amazon has the ability to weather that a bit more, and I think it really speaks to kind of what I was saying a second ago about the cloud business in terms of. And I think about this generally at a lot of industries, tough times being an opportunity for the industry leaders and companies with clear and sound strategic playbooks to continue executing, continue winning customers and taking share of wallet. So you may be seeing some of that there.
Totally. Another name that got absolutely crushed recently, I don't recall. Yeah, it was actually the day after their earnings. I think they dropped like 20%, was Roku. What happened there?
Yeah, I mean, Roku and Snap, it seems, I mean, in Roku's case, you had a business that was growing, I think it was mid 30s or so, maybe even higher than that. And they basically came out and said the Q3 guide is, low single digit growth. So it's, and like Snap, I don't know what the direct impacts are from some of these things, but I think it's fairly obvious that they're still proving out to advertisers, exactly where they kind of fit in terms of where their wallet goes. And when times get tough, it's probably a smaller bucket of their spend, and it's a place that they can probably pull back on, at least in the short term. So that kind of feels like what's happening there, at least to me. The Snap call in particular was, pretty discouraging in terms of some of the things they were saying and being able to prove out to advertisers that there's effectiveness to spend there. So, I own Meta, and I think about the issues that they're dealing with, and I reflect back on the fact that they have a $120 billion revenue base that they can kind of spend off of. And some of these smaller players are dealing with something in the, range of $5 billion. And that is a very significant disadvantage if the solution requires significant spend on AI, ML, infrastructure, things like it's just a very tough place to be in. So I'll be curious to see how they navigate it, but it does not sound like an easy position.
And is the general expectation they're losing a lot of users to TikTok, or is it more of a structural problem?
I'm not sure how much of that was in there. I think the DAU numbers continue to be fairly strong. They've kind of leveled out in some of the developed markets, but I think that's been a pretty consistent trend for a number of quarters now. It's the outside the US growth that's driving a lot of the DAUs. But again, people only care about DAU growth if you can actually monetize it on the back end and demonstrate a profitable business. And they're really struggling to do that second part right now. So people's, whether or not you came in 5% higher or lower than DAU guidance, it goes to the back when these concerns come to the front.
And how much of it do you think is potentially consumers being, I guess, a little more savvy around paid ads, right? They've just been exposed to them for so long now, right? It's been decades that we've been seeing these paid ads. And then what component of it could be influencers who are making their own money to go talk about a product that's not going through the Snapchat or the Instagram system?
Yeah, it's a good question. I really don't know the answer, and it speaks to a lot of these businesses, like a Yelp, that in my mind has pretty clearly demonstrated product market fit in terms of what consumers are looking for. But a lot of these consumer tech businesses struggle to then translate that to what's an actual viable business model that we can sustain with, large number of employees, large tech costs, et cetera, sales and marketing, all those things. And Snap, Twitter, Yelp, there's plenty of other examples. They've certainly grown revenues very significantly over the past 5 years, but the ability to translate that into a business model that is consistently and meaningfully profitable has proven to be a much more difficult challenge.
Yeah, I totally hear you there. I'm just going to start firing off of some items that I'm seeing here on the newsletter that I particularly have questions on. One is Oxy. I keep seeing, updates that Warren Buffett continues to buy this. Why is that the case?
It's interesting. I think a lot of this, and in the write-up, I talk about this example of PetroChina, which he invested in I believe it was 2003, put roughly $500 million into the position, and 4 years later sold it for roughly a 10x profit. And I think the setup may be somewhat similar in terms of what he sees in terms of the sustainable cash flow generation of this business, along with a clearly stated capital allocation and strategic approach going forward from this management team. And he obviously has some view about long-term oil prices that is tied into that. But I think he feels comfortable that if they stick to what they've said so far, and if the commodity environment is at least reasonable based on what the outlook seems to be today, he thinks it's at a valuation where it makes sense. And I think when you run through the numbers and think about it through that lens, I think it's fairly clear that the bet is at a minimum reasonable.
And are you also invested in Oxy or no?
I'm not. I mean, I own a good stake in Berkshire, so I guess I am. I am through. If someone keeps buying Oxy, I own more and more. Yeah.
Awesome. Another company that I see you talk about a bunch on Twitter is Spotify. Where do you feel Spotify is right now? What are some things that you're looking forward to in the future? And are you optimistic or pessimistic on the company?
Yeah, so the company recently had an investor day where, going into the investor day, as I told subscribers, I felt that their communication around some key KPIs, some disclosures that shareholders really needed to have to make an intelligent decision about a long-term investment in the business, I felt that was lacking. At the investor day, I think they did a pretty darn good job of disclosing some of those key things, one of which is the marketplace business, which is a very important part of what they're doing on the music side. Then they also gave some good disclosures on.
Can you touch more on that? Can you touch more on marketplace? I'm not familiar with that. What are they trying to do with the marketplace?
It's effectively a way to try to deliver, consider it like an ad product on the music side, where if someone that you're a fan of or could potentially be a fan of, they can essentially buy placement in your whether it's your feed or playlist, whatever it may be. So it's things like that. It's ways to feature artists where they'll get a reduced royalty on the play, but they have a chance to build an audience base, and obviously they can monetize in other avenues like concerts or merch, whatever it may be. So that's kind of the idea. They had talked about it before, but they'd been kind of unwilling to give the actual numbers. And when they gave the numbers at the investor day, it became clear that it was a bigger business than at least what I had assumed, and based on what I'd seen from sell side, higher than sell side I had assumed as well. So that was a key disclosure. They've since reported earnings, and I still need to dig in more, but you have this issue of, and it gets back to what I said on those consumer tech names, continue to report very strong user growth, both paid and free ad supported. But translating that into a business that is consistently and meaningfully profitable is where they still have more work to do. So they laid out the vision at the investor day and have it'll be a lot of work in order to make the numbers that they've kind of laid out there, but it's only been a quarter, so we'll see. But I think that's really where the story's at now. And then, on the podcast side and audiobooks and some of this other stuff, I think they're still really finding their footing is probably how I'd put it. I mean, especially in audiobooks, they're basically just starting. But even in podcasts, it's only been a handful of years, and they're still really trying to find the path forward. So I think it's a wait and see in a lot of ways.
And did they comment on, I believe it was called the Green Room, right? They had bought a Clubhouse-like competitor, and it looks like that kind of flopped, if I'm not mistaken.
Yeah, I think they're still basically figuring out what to do with it, is how I'd put it, how to include it in the product in a way that's sensible. And we can thankfully say that they bought Green Room instead of going out and paying $4 billion for Clubhouse. that would not have looked good, because I would venture a guess that Clubhouse usage is down quite a bit from where it was at the highs.
I would take that same bet. I also want to touch on another streaming company that you cover a bunch, Netflix. So Netflix was one of the early ones to kind of kick off this down cycle. They went down for, correct me if I'm wrong, they were close to 700 a share at one point.
It was up there, yeah, 600-700, something like that.
And then it's just been basically free fall since. They've recovered a bit over the past month or so. They made comments about wanting to release an ad-supported tier. What are your thoughts on Netflix?
Well, I have a lot of thoughts on Netflix. My overarching thought is that they've established a clear leadership position in the industry and have the most straightforward path to extending that to kind of true global scale in terms of a D2C business that has, call it something on the order of 50 or 60 billion in run rate D2C global revenues compared to today. They're right around 32, somewhere in that range. They've had a pretty significant change in their commentary around what the path that looks like, especially in terms of kind of the subscriber growth. And I think what we're seeing now across media generally is people coming to terms with the fact that there's going to be bumps in the road along the way to this long-term vision. And if you want to go even further than that, some people just directly question whether or not this long-term opportunity is actually real or worth chasing. So, I think Netflix remains very well positioned over the long term, given one, their leadership position, two, their clarity of what they're going after. They're not navigating structural decline in a linear business like most of the legacy US media companies are doing. So they have very clear focus. And in my opinion, their financial position and the trajectory of what their financials will look like will be very significantly impacted by that second consideration. You can look at companies like Warner Brothers Discovery or Paramount or NBC Universal, which is part of Comcast. And the road ahead for them is going to require some very difficult decision making. And, for example, Peacock, which is NBCU's D2C service, the number of subscribers was flat year over year, which is comparable to Netflix. The difference is that Peacock has 13 million paid subs and Netflix has 220 million paid subs. So it's in a very different place. And, Peacock revenues were down in the quarter. Peacock losses exceeded $2 billion in EBITDA for the first time. So, there's very clear pressures, and significant user adoption is not really being seen on the other end. So it demands the question of whether or not this is actually a worthwhile thing to pursue, or if another strategy is the right one to take. If the answer ultimately becomes the second one, which I'm pretty sure it eventually will, I think companies like Netflix and Disney are very well positioned to take advantage of those opportunities. So we'll see. This could still take quite a while to actually happen, but I think the future will be very bright for those two companies in particular, and maybe one other that can cobble together a strategy that's logical for the long term.
Amazing. That was super insightful. I want to touch on one other point. You've been great thus far. One, I kind of want to get some context about the structure of your newsletter. I'm pretty familiar, but I know people listening are probably interested. You share your portfolio publicly, right? And you do updates with your subscribers. This is on a quarterly basis. And I guess how much insight are you comfortable sharing now, if you want to give maybe like a teaser or two of certain holdings that are popular in your portfolio now, and kind of give the guest the framework that you use when structuring the newsletter and structuring your investments?
Sure. For people, a great place to start to figure out what my service is and really who I am and what kind of investor I am is I wrote a post called My Investment Philosophy, and there's no paywall. You can go read it for free. And it really outlines who I am and what I'm trying to do. So that's a great place to start. From there, what the service is, I worked for a decade in the finance industry, a buy-side equities analyst, and I decided to take the work that I was doing day-to-day there and just turn that into a product that I deliver to people through this service. So what it is I provide deep dives on new companies that I think are interesting and maybe worth owning. I provide quarterly updates on the names that I own and names that I'm following. I provide philosophy discussions, things like holding cash or other things along those lines. And then I also disclose anytime I make a change in the portfolio, I disclose it before I do it. And I tell people exactly what I'm doing in terms of percentage of the portfolio, what I'm buying, what I'm selling, why. And then on a quarterly basis, disclose returns and an updated portfolio view. So you get the updated portfolio anytime I make a change, or just on a quarterly basis. I'm I'm a long-term and concentrated investor. So there are some quarters where I just don't make any changes in the quarter.
Right. Sometimes nothing is the best action, right?
Yeah. It's funny. Running this service has made me even more patient and inactive and making changes meaningful. And I personally think it's been additive to the way that I invest. It's just a kind of continuation of where I'd been going anyways. But I'm very thoughtful about when I actually do something. And as a result, it tends to be a meaningful move. I'm not moving 50 basis points typically.
Yeah, that's awesome. I guess one other question on that then. Can you share what position you've increased the most since you started the service?
Sure. I think I mentioned before I own Dollar General. That was a new purchase since the service launched in April 2021. Another one has been Netflix. That wasn't in the portfolio either. So those are two that I've added. And again, I have big positions like Microsoft and Berkshire Hathaway. Those are two largest holdings, and they've been, I'm almost positive they've been either my top two or top three. They've been in the top two or top three for, I've owned them both for over a decade. So,
oh, wow. Amazing.
Yeah. So that gives some context for, how I kind of position and how I move things around from time to time.
Totally. Well, Alex, this was great. We fired through a ton of companies there. We'll release this full version, and we'll also chop up clips to where we highlight each company that you had insights on. But this is great. We'll include the link to the newsletter in the description of this podcast. And thanks a bunch for being a guest. I really appreciate it.
Awesome. That flew by. Thanks.